Hey everyone, in this video we are going to go over my rent versus short-term rental financial model. This is a free financial model that you can find on my website. I've linked it in the description, but essentially the goal of this model is to allow you to take an investment property and analyze it both as a rental property for a single tenant or as a Airbnb short-term rental and determine which is the best way to go. Because obviously, as a residential real estate investor, your goal is to maximize returns, as well as to lower the housing supply and destroy the middle class, and this model does a really good job of showing you the best way to do it. So we're going to start off with the Assumptions tab, and the Assumptions tab is where you can make all of the changes. This is where you make all of your assumptions for the specific deal. So let's go over everything that you can adjust. Everything with blue font, that means that's an editable field, so you can make changes to this, and anything in black font means that it's linked to another cell or just something that you shouldn't touch. So here you can see we have purchase assumptions. That's where you can enter in your purchase date, purchase price, and any closing costs or loan origination costs. Sales assumptions, this is where you can put in when you're planning on selling and what you're planning on getting for it. Obviously, further out you go in this market, there's really no telling what you're going to get, but we shall see. We have your loan assumptions, so you can enter in the loan amount, interest rate. I have 4%, that's an oversight. I think this is more like it. You can enter in the loan term and amortization as well. Renovations, so if you're planning on renovating the property before renting it out to somebody, you can put in the cost, and then you can put in how you want to straight line this cost over how many months. So this would be $25,000 over months 1 through 3. Annual operating assumptions. So this is for the rental assumptions. So for the rental assumption, you can put when you're planning on starting occupancy. So if you do have renovations, you might want to start it a month after. Annual rent is what you're going to be charging in rent. The extra revenue is anything extra you're going to charge on top of rent. So if you're planning on being reimbursed for utilities, or you're charging for parking or storage or anything other you can try to get $1 from, that's where you would put it. Occupancy, this is where obviously if a tenant leaves, you're going to have some downtime. So if you want to put in any downtime, you would just change this to anything lower than 100% to account for that. And then you can enter in your utilities, property taxes, insurance, and any capital expenditures. So that's all of that. Now you can go down to the growth rate. And this takes all of these different line items and allows you to grow it over a 10-year period, as this model allows you to go out 120 months or 10 years. So I always put 0% in the first year because everything I put in these annual assumptions is usually what I want the first year to be. And then I just do a safe, consistent growth rate for the rest of them. But if you are in a market where you think you can drive rents higher, you can always adjust these higher. But yeah, this is the overall look at the rental assumptions. Now going down to the short-term rental assumptions, these are pretty similar. I linked up the purchase and sale assumptions to the top. That's why these are showing in black. You can always change these if you would like. I did the same for the loan assumptions. The renovations, I allowed this to be in blue because in case you have any additional renovations that you would put in for short-term rental that you wouldn't put in for normal rental. The main difference is these annual operating assumptions. So we have an average daily rate now instead of the annual rent. So this is what you would be planning on charging during a typical day. You have your average stay length. You have your fees per stay. I don't know why I have 10,000 in here. I guess that is kind of common for Airbnb, but let's put this down to 200. Utilities, 2,000, property taxes, insurance, and then cost per clean. And this can really just be a cost per stay. This is an expense where any cost that you will incur after the guest stay, I put cost per clean because that's going to be your main one, to have the property cleaned, hopefully, before you have another tenant coming in. And then down here, we have the monthly ADR and occupancy. So this is the big change between the STR assumptions and the rental assumptions. So here we have the average daily rate, and you see a percentage in here for each month. And that just means this is the percentage of the average daily rate that you put in up here that you're planning on getting for that month. So if you're in a colder area, you're not going to get many people during the winter. This might be 50%. In the summer months, you might be up to 100% because that's what you're planning on getting. So this just allows you to adjust the average daily rate based on the month. You can also adjust the occupancy based on the month, and that will allow you to just get a good idea on a monthly basis what your returns are going to look like. And then down here, same thing as above, you can enter in the growth rate for each of these different line items. All of this information goes to these rent and STR tabs, and these are just monthly pro formas that are created based on the assumptions you put in on this tab. So this just gives you a look at each month and what you're going to be earning in net operating income, and then your levered cash flow after the renovations, CapEx, and debt service are taken out. So that's done for both the rent and short-term rent. And then all of this information goes on to the dashboard. So the dashboard is where you can compare the rent scenario and the short-term rental scenario. So it gives you all of the important information about your investment. You have the investment return, so you can take a look at your contributions, the distributions you'll get out, and what that net income is. You can also take a look at the IRR and the equity multiple. You have the purchase and sale assumptions, debt assumptions, and then sources and uses, so you can see where that equity and debt goes into. We also have the net operating income and average monthly rent tables or charts on the side. And then below that, we have an annual pro forma. So this just takes the information from the monthly pro forma and compacts it and makes it annual. And we just show the same information for the short-term rentals. So you have your investment information, purchase and sale, debt, sources and uses. Here we show the average daily rate instead of the average monthly rent, but it's all the same information, and you're able to take a look at which investment is going to get you the highest return, highest equity multiple, and just it allows you to make adjustments to your assumptions to see where the break-even point is, where it would make sense to do a short-term rental, how much you would need to charge, and where it might not. So this is the model, pretty simple. Again, it's free on my website. I've included a link in the description. If you have any questions on this, feel free to leave a comment. But yeah, that should do it. Thanks for watching.